The RBA just cut interest rates by 0.25%. But if you think that's going to make housing more affordable, think again. You see, history tells us things are about to take a strange turn, because you need to remember the rate cut, it's about inflation, not about you. Now, my team and I, we help busy professionals invest in the right property all around Australia every day. And right now, we're seeing signs that most people aren't as prepared as they should be. So today, I'm going to explain what the rate cut really means for property investors, what the latest market data is already showing us, and how smart investors are getting in before prices really take off. Picture this. You are looking to buy an investment property. You identify what you think could be a good market. You see a property that you like. It's advertised for offers over $599,000. Now, you're not naive enough to believe that. You then take the next step. You do your due diligence on what similar properties have sold for in the last 3 months. You can see that they're all selling roughly between about $625,000 and $635,000. So, based on that, you then go ahead and try and get the property for $630,000. You don't want to overspend, but at the same time, you don't want to miss out on a property in a location that you expect is going to rise quite significantly in the next few years. But to your total surprise, you find out that your offer was never in the running. There are multiple offers over $650,000 on this particular property. The property ends up selling for $660,000, a full $30,000 more than what you expected. Well, this is exactly what happened to a young couple, not just once, but 3 times in the last month before they realized they needed professional help, and that's when they came to us. But here's the thing. Just because of what my team and I do every single day, which is looking at properties, researching areas, we have seen a marked uplift in the amount of buyer interest for good quality properties in good areas. We're seeing more people attending open homes. We're seeing properties sell faster and faster, and we're seeing them sell for a lot more than, say, before the election. There is no doubt that ever since the election, and just with the expectation of the rate cut in May, the rate cut that we had in May was no surprise to almost anybody. Many people have been trying to get into the market before rates dropped in anticipation that prices are going to rise. And we know this is true because even the RBA came out in their latest statement after they announced the rate cut and said that housing affordability, well, that's not really in their control. They can't do anything about it. They just push the blame back onto the government. And rightfully so, because their focus, their mandate is to bring down inflation. They're not looking at property prices. That's not their focus. And so while almost everybody was celebrating the fact that rates were cut this month, I'm not so sure this is going to be the gift for first home buyers that many people think it is. If anything, it's only just going to force prices higher because of increased competition. So I'm not sure it's a gift for first home buyers. Rather, it's going to be fuel for property investors, as I'll explain shortly. Now, if you're starting to see the opportunity this latest rate cuts brings, and you want help to work out, well, where are the best places to buy, and how do you use this opportunity that the latest rate cut presents to build a property portfolio that's going to pay you a passive income each and every month, even if you've never invested before, then click the link in the description below to get totally for free the audio version and digital version of my book. It's a full property investing blueprint based on my now 23 years of investing experience that will show you how you can build a passive income through safe, strategic property investing. In fact, it contains the exact strategies we've used to help our clients build growing property portfolios without needing to spend late nights doing research all wasting their weekends attending auctions and open homes. But you might still be skeptical about how much property prices could rise. After all, prices in most capital cities, most regional markets have risen significantly over the last few years. Property isn't exactly affordable for many people in Australia. So let's have a look at this chart, which looks at the change in house prices in the 2 years after the start of a rate cut cycle. So in this instance, we're talking about how much property prices are likely to rise from February, when we had the first cut in this new rate cutting cycle. Now, the source of this data is the Bank of Queensland's chief economist. Now, when you look at this graph, what's one thing that you can notice immediately? Property prices on average never fell after rates started to be cut. They have always risen. The only difference is how much they rose. In the early 80s and early 90s, they didn't rise so much. But in other time periods, like especially after 1988 or 2003, and certainly after 2021, prices rose significantly. So then what is it that makes the difference when it comes to how much property prices are likely to rise? Number one, unemployment. Back in the early 80s, we had unemployment figures sitting at around 10% or so. Right now, our unemployment rates are really, really low. If anything, employment is surging. We're seeing employment levels at 95% or above. Well, what that means is essentially 19 out of every 20 Aussies who are looking for work are able to get a job. So employment is strong, which means people are able to go out there and get loans if they want to go and buy property. Number two is the strength of the Australian economy. In previous instances, when rates were cut, it was because the economy was really weak. We weren't seeing the growth that we needed, and so rates were cut. This particular rate cut is not because of weakness in the Australian economy. It's because of uncertainty and fear about what's happening globally, or what I like to call the Donald Trump effect. So in this case, our economy is actually quite strong, which is going to give people more confidence that they can keep their jobs, go out and get loans to buy property. Number three, the difference between the supply and demand for property that we have in Australia. Right now, demand is at all-time highs because our population is growing at about the fastest it really ever has, yet supply is really, really low. Construction is still very difficult. It's expensive. It takes time. Many people are worried about the risks of building their own home. That's why people are looking to buy established property. So we have more demand relative to the amount of supply that we have. Now, with all the confidence that I just mentioned, because of strong employment, strong economy, we're going to see more demand placed onto the property market, more buyers relative to the number of properties available for sale in multiple areas around the country. And most of those new buyers are going to be able to enter the market because they're going to have more confidence now that rates have fallen, their borrowing capacity would have increased since the start of this year. And so all of that is going to just increase demand versus supply, forcing property prices higher. So to me, if you're able to afford to buy an investment property, the sooner you buy in the right areas, the bigger the opportunity this latest rate cut presents for you. And look, this isn't just theory, right? This is already showing up in the latest market data. We're seeing an increase in auction clearance rates around the country. We're seeing an increase in the number of auctions. For example, the Brisbane auction market has increased by 75% due to the amount of confidence that's happening in Brisbane. We're seeing similar things in Melbourne, parts of Sydney, Adelaide. There is a lot of confidence in the property market right now. We know that last month, property prices rose 0.3%. And as I record this, based on what we're seeing in the data, prices for May are expected to rise even more than what we see in April. The rate of increase in prices is getting faster and faster. Now, I am talking about median price data on a nationwide level and I guess a city by city level. You still always need to do your due diligence because not every area is going to perform as well. But here's the thing. yes, we've had the latest rate cut, but nothing has actually changed in the marketplace. What I mean by that is, yes, the big four banks have agreed that they're going to pass on the rate cuts, but most of them don't pass them on until next month. Secondly, most people's borrowing capacities haven't changed yet because the rate cut has come through. It's going to take a few weeks for the banks to update their various borrowing capacity calculators. So there is actually no difference between the days prior to the latest rate cut and the days since the latest rate cut. And yet property prices are already starting to rise even before the full impact of the rate cuts have actually been passed through. So what do you think is going to happen once everyone's borrowing capacities have improved, once people actually see their mortgage payments reduce, and then they might have more confidence to go out there into the marketplace and buy another property for investment purposes or to help their children? We're already seeing the pace of growth in the property market increase, and that's only going to continue. But of course, you might still be wondering, okay, Nero, you're talking rate cuts, but prices are already so unaffordable. Isn't this just a short-term sugar hit? Maybe prices might rise a little bit, but then they're going to go flat again. Fair point. And I see so many people think that way, but sadly, they're going to get it wrong because we know from the latest announcement from the RBA that they are actually concerned about what's happening on a global front. They actually talked about potentially reducing rates not by 0.25%, but by 0.5%. So they were actually debating a double rate cut. Now, they've only given us one rate cut, sure, but based on what we saw in the latest RBA statement, my interpretation is the odds are we're going to see more rate cuts throughout the rest of this year. And so the momentum is just going to keep building for the property market. In fact, PropTrack have released some data based on what they think could happen to property prices if we just see what happened in the last 5 years repeat in the next 5 years. And the results are quite scary for anyone who thinks property prices might drop in the near future. What your home could be worth by 2030. Australians are staring down the barrel of some truly epic home price increases, with property values expected to double across many areas in as little as 5 years. Now, the article then goes on to say, though, that they don't expect prices to rise everywhere. Some areas may drop, but on average, the median house price in Australia is likely to increase with, like the article said, some areas expected to double. In fact, if we go through some of their predictions, they are quite astonishing. Sydney, for example, already our most expensive market, PropTrack analysis foreshadows that the average house price could rise by a staggering 61% over the next 5 years, taking the median up to $2.4 million, up from $1.49 million. That's an increase of nearly $1 million on the median house price in Sydney in just the next 5 years alone. Adelaide, a market that has already seen a significant uplift in property prices, and many people are wondering, well, can prices actually keep rising in Adelaide? Well, according to PropTrack, they can. PropTrack says local and interstate demand for Adelaide has been so great that it's driven up house prices by 75% since 2020 and 64% for units. It means that if prices were to continue like they have been for the past 5 years, house prices could jump to a new $1.474 million median by 2030. In Melbourne, PropTrack expects the median house price to rise by $146,000 over the next 5 years. Now, I personally think that's really undercooked because from what we're seeing based on my on-the-ground data and on-the-ground research, we're definitely seeing a lot more momentum in the Melbourne market compared to what we saw in the last 5 years. So I do expect that the median price for property in Melbourne will rise a lot more than this conservative $146,000. And finally, Brisbane. The price of a typical Queensland home could surge by nearly $700,000 to an eye-watering $1.53 million by 2030 if the extraordinary growth of the past 5 years were to continue. And I fully expect that we're going to see similar growth rates in Brisbane over the next 5 years like we've seen in the past 5 years, if not even more. So what all of this is showing is that for people who want to wait for a better time to buy an investment property, there isn't going to be a better time. they're just going to miss out on some significant gains. We are already in a position where in most capital cities, you're going to struggle to find a good quality property for under $1 million and certainly under $800,000. Based on what we're seeing with the data from PropTrack, we could easily be in a situation by 2030 where the median house price in most capital cities is $1.4 million or $1.5 million and above, all the way up to $2.4 million in Sydney. It's some truly astronomical gains that we're talking about for those people who choose to act and buy in the right areas. But also, it's an astronomical amount of regret for those people who can afford to buy an investment property but choose to sit on the sidelines and wait to see if prices really do rise. They're not going to fall. Prices have never fallen in Australia once a rate cutting cycle has started. I showed you that earlier on. I truly believe we're going to see some huge gains in the property market in multiple areas, not everywhere, but certainly multiple areas, because of how low unemployment is, because of how strong the economy is, because of the massive demand versus supply gap that we have in multiple areas around Australia. And to get the benefit of that, you want to act as fast as you can, as soon as you can afford to, but focus on buying in areas where there's high demand from owner-occupiers relative to the supply of properties in that area. So hopefully you can see what this latest rate cut means for the property market, how much waiting could actually cost you. But yes, buying property as soon as you can afford is a great first step. Identifying the right areas to get the maximum gain is a very important part of the process. But getting started is just the first step in the process. To truly achieve financial freedom, you need to have the right strategy so that you can build a property portfolio the right way. And if you want to find out more about that, check out this latest video where I walk you through the 10 steps to making $10,000 a month passive income through property.